All right, everyone. Thank you for joining us. I am Matt Ryan. I'm the Revive. I greatly appreciate you guys joining us here. And before we begin, just a quick disclaimer. All right. And thank you again for those of you who maybe joined us in that interim. Again, my name is Matt Ryan. I'm the principal here at Revive. And we're thrilled to be bringing to you guys 1741 Gaylord Street here in Denver. Um, a little bit of background about this deal. We are purchasing this from a developer who bought it in the purpose of demoing it, so he could have room for some utility work for his ground up development, which is two doors down from us. The city of Denver received a ton of feedback regarding the proposed demolition, and eventually retroactively designated it a landmark structure, thus putting a wrench in his plans to demo it. We were then brought the deal from some brokers off market, knowing our history in the market and our model for shared living. We thought it was a great fit, and we've been negotiating with them for several months and are now currently under contract. There is two elements to this deal that we'll be covering today. Most of what we're going to be covering is going to be the existing renovation of this beautiful building to 16 rooms of shared living, aka co-living. And in addition to a ground up portion, which is the phase two, which we'll just be mentioning. But the reason that impacts is effectively we're going to be taking a piece of the land that is adjacent to Gaylord here and extracting that land for phase two, which is of course going to reduce our basis in the existing property. A quick snippet about that: we are entitling the ground up portion, and we can walk away from the project if we do not secure those entitlements. Part of our contract stipulates that if we do not get the entitlement from the planning office to erect these 32 units next door, we can essentially walk away. Now, everything that you guys are going to see in this deal today speaks specifically to the fact that we can renovate the building and then sell the land off. We've basically looked at it in a bottom land exit value. And so the metrics that you're going to see are based on that scenario. So now that we've covered all that, a little bit more about the building. So again, 16 rooms, 7 of those rooms will have ensuite bathrooms. The remaining 6 rooms will have shared bathrooms. There will be a combination of 3 kitchens, 1 primary kitchen on the first floor and 2 kitchenettes on the second and third floor. We'll have a large dining room on the first floor. Additional amenities, we'll have a yoga meditation room in the basement, washer and dryers on all 4 levels, in addition to ample storage in all levels. This product type, in our strategy of converting distressed office buildings to apartments, specifically shared living or co-living, furthers our strategy. This will be the second office to residential conversion that we've done, or excuse me, the third office to residential conversion that we've done, the second in the Denver market, the other project being in Sacramento. And it furthers our commitment of this affordable by design, delivering product that is affordable to young people in high demand markets in great neighborhoods. Moving into a little bit more specifics about the deal here, you can see, as we discussed, 16 rooms, the square footage, lot size being 15,000 square feet. Again, we'll be extracting some of that land to then build a ground up component, which we'll cover a little bit later. Equity and debt. So we've underwritten fairly conservatively on a loan to cost, 50% for the bridge loan, 70% at refinance. We'll talk about this a little bit later as far as, why we did it that way. But for all sake and purposes, this is what we're estimating on our debt at this point and what these projections are based off of. This is, of course, based on our experience with regional bank, which is kind of our intent to move forward with that, which we've secured on both deals, in addition to maybe pushing some things out in the private debt markets as well. You see here, there are 2 IRRs. There's the project level, and then there's the net to investor. Everything you will see pretty much within this is net to investor. Everything that you've seen on the landing page is net to investor, meaning to you as the investor, not project level. For those of you who are newer LPs and maybe not as experienced in the real estate game, I'm happy to explain this offline, but the simplest way that I can put it to you is it's the profit margin that Revive as a sponsor keeps. That's the difference between this 20 and 17 number here. The targeted hold period is 5 years. We benchmark all of our deals to 5-year holds. We tell everyone we could sell in year 2, year 3 at stabilization. We may pitch to our investors that at year 5, we go out and refinance the deal, return a majority of capital to investors, which would be an ideal scenario, and continue on with high single digit, if not low double digit cash flow on a great building and a, irreplaceable location. We benchmark to 5 years, so you guys have an apples to apples comparison in the broader market. But as with anything, our fiduciary responsibility is to get you guys the highest and best return, and that's what we're essentially committed to. As far as things that we like about this deal, well, the first one essentially is just the location. I encourage everyone to click this link. If you're not familiar with the Denver area, go down the street, go 2 blocks to City Park West. It's really an unparalleled location. It's a rows of beautiful mansions, that have been converted into offices or extremely high-end single-family homes. The second piece for us is, as we call in the real estate game, the basis, right? Our entry price. If you just look at the asset and our contract price today, we're at $187 a foot, which is pretty good considering, as you'll see later, what the comparable multifamily buildings are trading for. When you remove the land that we'll be developing next door for the phase 2, it brings our basis down to $122 a square foot. Again, so kind of just bringing this whole picture, imagine buying that building that I just displayed in these prior pictures and saying you can get this building for $122 a square foot in a great location of City Park West in a market like Denver. It is kind of unheard of. The other component is, given our shared living model, these office resis, especially buildings that were obviously previously residential, are great and they're conducive to this type of conversion. This one in particular, this being the third project, of all the previous 2 projects, I would say this one has the, call it, easiest transition from a tenant improvement, from a construction perspective. And we'll kind of look at that and you'll be able to see that once we get into the floor plans. Another component more relevant to our underwriting is that what we're programming in when we lease up 20 months from now, or 20 months from the close of escrow, is today's rents. And I just double checked the rents that we pro forma that we projected for this project, and they're about $75 higher than what we're getting in our current Denver project over in Sloan's Lake area, West Colfax, which is not as good of a submarket, but still a high demand, young market. So again, there's a lot of people in this world, in the apartment investing world, macroeconomics world, are projecting pretty significant rent growth in 2025, 2026, around the time that we'll be delivering this product. We are estimating completely flat rents. So we do feel like there's some runway there. Additionally, the deal breaks even with a low occupancy, low downside risk. So if we only lease 11 out of 16 bedrooms, which the average vacancy rate for co-living, shared living is right around 8%. We still break even for investors. The last thing that I would say that we really like about this deal is, again, the floor plates and just the way that the bedroom sizes are becoming. When you get an existing building, sometimes you end up with some funky bedrooms that are under 125 a foot. I know there's been a lot of co-living operators who have really struggled with those smaller bedroom sizes. They typically turn over a lot more. They typically don't rent as well. I would say that's what I really like about this deal, is that these bedrooms are all fairly sizable. Reviewing the potential risk, as we discussed earlier in the executive summary, if we don't get the rezone, we are able to walk away with no cost to our investors. And we'll talk about that. But essentially, if you put a deposit in a soft commit, we will cover all the due diligence costs if we walk away. If we don't get the rezone, again, everything that is financially modeled here is based on renovating the deal and selling off this land at a low $80 per land foot. We're evaluating that on today's land market, which is frankly one of the probably the lowest it's been, right? Even if we go another 6 to 12 months, I do feel like there's upward mobility in that land price. With respect to the building conversion, obviously office to resi conversions are complex. They can be challenging. Again, being that this building was originally built as residential, I think reduces some of that complexity. And the other component of that is that because we could essentially apply for a building permit and change of use tomorrow if we weren't doing the ground up next door. We will be submitting a building permit application, which will be in review as part of the planning review process. So we should be getting feedback from the building department on particular issues that may come up during construction as we're going through the planning of approval process. Last thing on that, you know, and we'll talk about this in the construction costs, or I'll talk about it now. We're bringing in our GC very early on. We're literally involved with them in the due diligence process right now and hiring them on pre-construction to work with the architect directly on the schematics, taking what we've understood and known and getting them early in on the bidding process and estimation process to also help us point out any potential things that could create cost overruns. The bad debt markets, we kind of bring this up just because I know it's been a really hot topic in the real estate world. Debt's been incredibly difficult to secure. So again, we've kept our loan to cost ratios fairly low. And in addition to that, when we go to refinance, we're at a debt ratio of 1.58. For those of you who don't know what that means, banks are typically allowing you to refinance at 1.25 to 1.35. So again, I think we have considerable cushion there as we go into refinance, not even considering if rates don't change, which of course we would all love for them to go down. I know that's what everyone's hoping for. But you know, again, I think we have considerable cushion there. On construction costs, again, bringing a GC on early on in the pre-construction process, bidding process. We're working with a general contractor who was referred to us from the architectural firm who's done these types of projects before. The general contractor that we used on the first project in Denver is also engaged with us, but is a little bit leery about doing the ground up portion. They typically do high-end residential renovations. So it's unfortunate that we may not be able to move forward with them. But from an underwriting perspective, from a financial modeling perspective, even if we see cost overruns of 30 or 50%, which is, again, likely but unlikely at this point, we're still looking at a 12%, 9% internal rate of return. You know, it's not great. It's not the 17 that we're estimating for, but it's something that's still going to beat the S&P 500. Perhaps the most important slide, and why we try to include it for you guys early on, is what does a $100,000 investment look like? And a quick caveat to that, our minimum here at Revive is $35,000, which is fairly low relative to other sponsors. We want to allow anyone to get into these deals. We don't want to create big barriers of entry. We've modeled this for $100,000 because it's a little bit of an easier number to look at and it's just flat. So what are you guys looking at here? Obviously the refinance, we're looking at a makeup of pref and return of equity when we refinance. That's when we come out of construction, we put permanent debt on it, we lease up. So big returns of capital happening to our investors. And then beyond that, you know, again, a really strong cash for an infill, high demand market like Denver. You're typically not seeing these type of cash on cash returns and deals like this. You typically have to go out to the suburbs or a tertiary market where you're doing a cash flow play. We're getting cash flow play plus potential for obviously significant equity upside. The equity multiple, those of you who have done deals, LPs that have done deals before, you hopefully understand what this means. But for those of you who are new, it's basically you give us $100,000 and in year 5, if we were to exit, we're saying that we estimate that we can double your money in that 5-year period. The construction timeline that I put in front of you right now is from the close of escrow. We're currently estimated to close escrow in March of 2025. Again, we'll get to this down in the investor slide in a minute, but we're asking for a deposit up front. So that is not inclusive of this timeline. But again, a close of escrow in March of 2025. And again, we'll have already submitted our building application that will be reviewed and be in the building department's office for several months before. And then once we get planning review, then we can go and get our building permits. We've always coincided demo early on. If we can do it, we'll do it in this project. For context, we've typically seen about 12 months of construction timeline in past projects. So we feel like we have a good conservative runway here in this particular project as well. Going over to the property itself, one of the things that we love the most about this property, and we've gotten a ton of wonderful compliments, which we're very appreciative of, is just the aesthetic of it and the architectural features of it. Stewart Street, I'm a little bit biased because that's the building that I own over in Denver. That's also our co-living building. Architecturally is a little cooler, has some really beautiful woodwork in there, but Gaylord's equally as cool of a building. As you see here in the front left, this is the main entryway, or what will essentially be a living room to the left. Top right, that's with the beautiful stained glass and windows. That's what will be the dining room for the first floor. Your bottom left is the third story attic space, which will be parceled out into individual bedrooms with baths. And of course, this stairwell on the bottom right, which is just absolutely gorgeous. We've got some, hopefully you guys have seen some of the cool pictures from that stairwell looking up and the beautiful stained glass. This top left is the first story kitchen. I know what everyone's thinking. It's a pretty ugly kitchen. What we see is significant cost savings because we won't be changing the format of this kitchen. We'll just be swapping out the cabinet faces, upgrading appliances and countertops, which is a way, way simpler process, obviously, than demoing out and completely redoing a new kitchen. Top right, the building is currently used as an office by the developer, as we talked about, but that's a first floor room that'll be converted into a bedroom. Again, your bottom left is the main living room that'll be converted to living room, currently used as, a nice spot for renderings for our developer friend. The bottom right is what will become a bedroom. Again, a lot of great period details, fireplaces, as you can see, just really incredible features. A few snapshots of the exterior. It's a little bit of a wreck right now because you can see bottom left, we have the developer pouring his foundation for the ground up portion. If for those of you who are looking at that lot and thinking what I thought the first time, it is a lot wider. They've deeply excavated about 10 feet over there by foundation. So I can't remember the exact dimensions. I think it's about 45, 48 feet. So we got plenty of space for the ground up component moving forward. Moving into the floor plates, we'll kind of breeze through these. I just want you guys to see the lightness of the renovation, right? This is our basement. We're doing very little. We're not creating a ton of walls. Closets, bathrooms, those are kind of the core. Your plumbing mechanical is usually your biggest expense. And that's kind of the beauty of this deal, is that we're every time you do frame a wall, now you got to sheetrock it, now you got to insulate it, you got to run electrical, you got to do those things. And I think we're excited about this one, mainly because the floor plate just very much works for what it's going to become. So we see it as a fairly light retrofit. Moving on to the third story, this is where things get a little bit more dense. Rooms start to get a little bit smaller, but as we talked about, providing an ensuite definitely changes the game. This is being able to rent one of these bedrooms with an ensuite bath for, say, under $1,450 or $1,500 a month, relative to a studio that's in the 18.9s is a big deal for someone. Quickly touching on the site plan, you can see Gaylord, the kind of the aerial view here of the building itself and the outline in the middle. The site plan for the 32 unit, this would be a 3-story walk-up product, combination of micros and 1 bedrooms. We're currently hashing that out. Again, deeply committing to this idea of affordable by design. We'll talk about what that means when we go into our rental comps, but this is the portion that any investor in phase 1 would have optionality to be able to go in and invest in phase 2. So you'll have first right of refusal. Again, adding this adjacent lot adds significant value and density to not only the lot, but also to the neighborhood. Taking a step back and kind of looking at the market and sub-market. Anecdotally for me, I was very close to moving to Denver before I moved to San Francisco. Been here 9 years. Got bit by the West Coast bug, but Denver was definitely on my radar. And now my wife, unfortunately, has to hear me talk about Denver every time I go there, and how much I love it and how great it is and how much I love the weather relative to our cold summers here in San Francisco. There's obviously some fabulous statistics on here. City Park West, as we talked about earlier, it's just a phenomenal neighborhood. I've spent some time in the park itself at the zoo, seeing a concert there. Again, just it's really been cool to see how Denver's created its own identity, and also how much the neighborhoods have created their own identity. And I think that's the mark of a great city is the neighborhoods. It still has a ton of room to grow, in my opinion. They've done a great job of allowing building to happen, so young people are continuing to flock to Denver. Um, and we're really, just like I said, enthralled with the location. Um, from our tenants' perspective, everything's in good proximity. It's less than a 10-minute drive to downtown. Again, you're 2 blocks away from City Park West. This particular neighborhood has a great mix up of retail that's all walkable. Denver's not known for its transit, but it is certainly a walkable and certainly a bike community, which has great infrastructure in and around the location itself. When we talk about our ideal demographic for a neighborhood and for co-living specifically, I don't think we can have City Park West nail it any better. You can see here the makeup of 18 to 34-year-olds, single, college education, a mixture of white collar workers. Of course, we also get individuals who are maybe service retail, have a less than a bachelor's degree or graduate high school and are working those jobs. But just the medium household income and the level of educational attainment and number of single young individuals in this neighborhood, we feel is extremely promising. And it's also just why it's such a highly desirable neighborhood. If you've been following Revive for the last 2 to 3 years, we've been probably even longer than that. We've been super bullish on the co-living model. We know it's taken its lumps in the marketplace. But the reason we're still believe in it is just this affordability issue that this 45 million Gen Zs are facing. They're as large of a cohort as the millennials. The economic conditions that they have as they're entering the job market now are very similar to what the millennials faced in 2011 and 2012, coming out of the 2009 recession. They're paying between 35 to 42% of their income, but they want to be in these great neighborhoods, in these great cities. And from our model, what we love, in addition to solving that problem for them by delivering basically a brand new renovated product at the bottom 30% of the rental market, is we feel like we have far to our competition. We're better priced. We're 36 below Denver's average rent price. So we're, the average developer who's delivering a new studio or one bedroom is delivering at the very top of the market, $2,000, $1,800. Well, again, we're kind of delivering here right in this perfect mix of, the $13 to $14, $1,500. When you take that in comparison to what other options people have and living and renting in a studio, you come up with a cost savings about $300 to $500 per month. Okay. And if you think about co-living as a competitor to the roommate share model, where individuals get 2, 3, 4 bedroom houses, they divvy it up, they get their friends, they try to bring in roommates, a model that's very common in major cities. It creates a lot of friction. How are you going to split the utilities? Who's going to clean the place? Who's going to supply the basic necessities? Who's going to take care of the Wi-Fi, right? And I think why we've seen so much growth in the co-living models, it takes all that friction away for the individuals, where basically I'm just signing a lease, moving my stuff in an individual room. All the common areas are already professionally designed for me and furnished. And again, just reducing that friction for those individuals on top of a cost savings. A quick little note, without doing a larger sociology lecture here. This cohort, this group of individuals, because they came out of the pandemic, suffering from a lack of engagement, a lack of community. I think that's where our model adds just kind of an ancillary benefit. We talk about, the hierarchy of needs in co-living, do the basics really, really well first, but then also create community and community interactions. And for someone maybe who's new to a city, or is graduating college, has friends move away, I mean, this is just a great way for people to get integrated into a new city or make new friends, versus just living alone in the studio by themselves and paying a lot more money. When it comes to our renovation plan, we really double down in this idea of selective demo and soundproofing and insulation. I mean, sound transmission is integral to what we do and reducing it. So like on this top right picture here is a picture of our 1022 G Street deal in Sacramento, where we're stripping down at least one side of the wall, installing rock wool insulation, doing J channels, drywall. We're getting to an STC, a sound transmission rating that actually exceeds new construction standards. It's a very important part of our model. And then, of course, we're upgrading the common amenities. As you see, this bottom left picture is beautiful painted curtains in the bathroom. I do actually love the sink of the particular bathroom on the second floor and would love to find a way to keep it. And somehow it's got to be 300 pounds. And then, of course, bottom right is a picture of our completely renovated bathrooms at our Stewart Street project there in Denver. We talked about the kitchen in the top left, and top right is just a quick rendering of the Stewart Street kitchens there. Again, bottom left is just a kind of a comparable picture of existing Gaylord. And bottom right, you can see how our magnificent interior designer did such a great job furnishing and really upgrading the aesthetics of the common areas there at Stewart Street. Sales analysis, it's a little bit apples to oranges. Obviously, we're taking multifamily comps that aren't renting under this type of guise, this type of model. But we did try to find comps that we felt were relevant, not just in size, but age. It's obviously also very difficult to find a vintage 1903 building that's been completely rehabbed like we're going to rehab it. But I think one of the things that we enjoy about the way that we underwrite, the way that we project our deals, is that we're putting a pretty substantial cushion between exit cap rate in the marketplace and what we're looking to exit on. So everything that you guys have seen from the financial model is based on us exiting at a 5.5 cap. So for those of you who know and have done real estate deals, 50 to 75 basis points on an exit cap can really make a difference in the profitability of a deal. So we feel like we have significant cushion here. And, as the market is right now with interest rates and everything like that, we're not here to get into a discussion about cap rates and all that stuff. We just know that we have the cushion and the deal works under a conservative guise at 5.5, where the market's generally achieving 4.6. For those of you who want to deep dive more into the financials and for transparency purposes, we've included a full 10-year model here. We've also included the sources and uses. Again, for those of you who really want to dive in, I know some people really want to see the numbers and understand all the components of it. That's all here for you guys to review. And on to our fee structure. We charge a flat 3% acquisition fee for the total project cost on projects of this size, anything under $3 million. 3% asset management, that's 3% on the net collected rent. So only the rent that we collect after vacancy, bad debt. A 3% disposition fee, which is just the delta between our purchase price and the sales price. As I said earlier, our minimum investment is $35,000. We will be paying dividends, distributions on a quarterly basis, and all investors are going to enjoy an 8% preferred return, with 70% going to you as an investor at profit and the remaining 30% going to us as a sponsor. The estimated time frame, we are all asking for all investor commitments, soft commitments, and deposits by 7/31. Simply request any documentation you need from me. We'll get it over to you in the meantime. The remaining deposits we'll start collecting in March of next year, again, with a rough target of April of 2025 to close the escrow, again, based on the entitlement process being completed at around that time. On to the team. Dane, our acquisitions extraordinaire, coming over from Mad City Development, where he was also the COO of Madeline Group. Maison, a brand that he helped, co-living brand that he helped build and expand over in Brooklyn, Manhattan. Extremely well-versed in this space of co-living, micro apartments. We talked for over a year, friends for over a year before we finally came on board. Obviously, overly qualified for his title, but the guy is just absolutely crushing. He's put over $250 million of potential deals in our pipeline for this office to resi conversion strategy. There's definitely going to be a lot more deals coming from Dane, and we're absolutely thrilled to have him on board. Was also co-founder of one of the first venture-backed international co-living companies, Rome. Sam, who recently joined us over from Cul-de-sac, extensive experience in this kind of urbanism startup world and divisional horizontal development. Super well versed on the underwriting side of things. Again, someone probably far exceeding his title there. But I think that's one of the cool things about this team that we've developed is we don't really hang ourselves on titles. We just pretty much roll up our sleeves and get to work. It's been great to have those guys on board. And over to Miss Antoinette, our lovely property and asset management. We brought Antoinette on for asset management only. She was referred to us from Open Door, which was for 10 years operated co-living properties all up and down the West Coast. Ben and Jay moved on and on to other things, but Antoinette has stayed on and managed some of their customers' projects here in the Bay. Again, we started her out with asset management, and she since came on and has taken on all property management for all of our sites in Sacramento and for Denver. Absolutely thrilled to have her on board and continue to build a team around here for this very niche product. For me, I'm the acting general partner. I have 15 years construction experience. I started my first company, bootstrapped my first construction company in 2010, focusing on energy efficiency and green building in the Southeast market. Again, I moved to San Francisco about 9 years ago and started re-viv, building on my passion for urban policy, community revitalization, and this growing concept of what is affordable by design. How do we deliver affordable housing, not without subsidy, but also not market rate? Kind of marrying this beautiful little middle ground where we can deliver a product that's affordable to people by slightly varying on certain types of housing models. My previous investment history has yielded about a 27% internal rate of return on realized investments, and have built a portfolio of about 15 million of asset management under 6 sites. Other partners, SK2 previously worked with Dane on a ground up development there in Denver. Kevin's been absolutely phenomenal, extremely well experienced architect. Very excited to work with him on this particular project. It will be our first time working with Kevin, but not his first time not only handling an office to resi conversion, but a historical renovation. Very excited. Borman, our old architect who worked on Stewart Street, if you do happen to listen to this, we do miss you, buddy, but we know you're doing great things in Lake Tahoe, and hope all's going well. Wish we could have you on board, but Kevin's crushing it. And then, of course, Caitlin, who's come on as a land use attorney to help us with the entitlement process. Absolutely phenomenal, top-notch land use attorney in Denver. The guys at Taft in Chicago, our Costas and crew, our securities and general counsel. So happy to have you guys on board, and our local CPA here, Sensiba, here in the Bay Area. At this point in time, we'll wrap it up and open everything up for questions. And while we're doing this, guys, I'm just going to turn video off just 1 second so I can pull up this Q&A. Awesome. So first question that I have here is, has re-viv worked on a historic landmark building before? If so, can you talk more about that element? So both of our co-living properties, the Denver asset was a historic landmark. So yes, we have worked on that before. The Sacramento project was in a historic district, but not an actual historic landmark itself. So yes, we have done under both. The nice thing is about this property, in addition to the other ones, we had very minimal external repairs that needed to be made. It's oftentimes swapping out a window, or windows for that matter. The Denver project, that was a story in itself, but we basically had these very articulate archtop windows that had to be custom built. We don't have that in this particular instance with Gaylord, but yeah, we do have extensive experience in these types of projects. Do we need to rip out and remodel the kitchen? No, I think we're going to keep the existing cabinetry in place, resurface the cabinets, install new countertops, tile, and appliances. So keep that down to a minimum. What is our current rent roll at the other Denver projects, and how does it stack up to this project? So our current rent roll at Stewart Street is an average about 1350, which was actually a 15% increase over our pro forma value. So again, like we're very conservative. We've actually exceeded what we projected on rents. So our average rent roll over at Gaylord is going to be about 1475. So we're a little bit higher, obviously. But again, the City Park West market's a much more desirable market than the West Colfax. Is the time given in the fourth or fifth slide from the time of deposit or close of escrow? So the timeline that you saw was from the close of escrow. Couple more coming in here. What happens if we make a deposit, but the investor does not move forward? Well, obviously, we would hope that that doesn't happen. We understand things do happen. We will return your deposit. There will just be a small fee that'll be associated with this, but you will get your deposit back. Looks like someone has a follow-up question to that. Like, what happens if we make a deposit, but you decide not to move forward with the project? Again, if we don't secure the entitlements, we can walk away. We have the ability to walk away from the project. No due diligence cost will be assessed to any of the depositors if we do that. We can still move forward on the renovation and sell of the land, and we will discuss that openly with our investors once we get to that point. Again, everything that we projected today is based on us not securing entitlements. So we've kind of already modeled the worst case scenario for you guys. All right. I think that is, oh, how does construction cost stack up relative to the other projects re-viv has completed? For this particular project, we are looking at about a 28% increase in hard costs over past projects. From our Stewart Street project, which had extensive exterior renovations, we had to tear out an entire stairwell. In addition to a switch of GC in the middle of the project, we saw about a 16% decrease in cost project over project. The Sacramento project had a little bit higher fire separation. We basically treated it like 3 separate units, which increased costs in that regard. We don't have that on Gaylord here as well. All right. I think that's a wrap for everyone. If anyone has any more questions, feel free to reach out. Within the landing page, I believe there's a link. You can schedule a call with me directly, or feel free to email me at matt.ryan, that's RYAN, @re-viv. I greatly appreciate everyone's time today, and have a good rest of your day.